All right, let's talk about a situation that can get any trader's heart pumping. You've got a position on, and suddenly the stock goes absolutely vertical against you. Today, we're going to break down a real playbook for how to manage that kind of high-stakes scenario.
Okay, so let's set the scene. Imagine you're in a common options trade, a strangle, where you've sold a call way up high and a put way down low. Suddenly, the stock just explodes to the upside. That short call you sold is now deep in the danger zone, and the pressure is building every single day. Look, panic is not a strategy, but having a plan, now that is.
So the first thing we have to do is stop guessing and start quantifying the risk. When a stock is in price discovery mode like this, trading at all-time highs, it feels like it could go anywhere. We need a map. We have to look at the technical price targets to get a real sense of just how high this thing could actually fly.
And that map often comes from these Fibonacci extension levels. You can see they act almost like magnets for the price. Sure, there's a hurdle around 942, but the real big one, the critical zone, is right around 1022. Why? Well, it's a perfect storm. You've got the mathematical golden ratio lining up with the huge psychological barrier of a 4-digit stock price. That's a major zone of potential resistance.
So the technical chart gives us a good idea of where the stock could go, but to really understand the why it has so much incredible momentum, we have to look at the fundamental story. And right now, Wall Street is pouring gasoline on this fire with some incredibly bullish outlooks.
Take Mizuho, for instance. They've aggressively jacked up their price target to that 4-digit milestone. And their reasoning? Surging prices in the flash memory sector. They're so bullish, they're reporting that the company's 2026 manufacturing capacity is already completely sold out. Think about that.
And they're not alone. Bernstein is setting their base case even higher, targeting 1250. And their argument is really interesting. They're saying that even after this insane run-up, the stock's valuation is still, believe it or not, surprisingly cheap when you look at its future earnings.
And then you see this, and this is where it just gets wild. Bernstein's blue sky scenario, their absolute best case outlook, projects a potential price of $3,000. I mean, that's a jaw-dropping 250% upside from where it is now. That's a clear signal that the big money thinks this thing has a lot more room to run.
So this slide really pulls it all together. This rally isn't just hype. There's a real story behind it. The main idea is that massive earnings growth is actually keeping the stock's valuation, its forward PE, surprisingly low. Bernstein points out it's trading at just 9 times forward earnings. Even pretty conservative models suggest a $1,400 price is justifiable.
So what do? You've got this freight train of technical and fundamental momentum coming right at your position. You can't just sit there and hope it stops. A disciplined trader needs a clear, methodical plan, and in this case, the solution is a solid, two-pronged approach to repair the trade.
Okay, let's break down the mechanics. We'll start with prong number 1, the defensive maneuver. The absolute top priority is to deal with the immediate danger, and that's our short call option, which is completely under siege right now.
This quote right here, this is everything. It's so easy to get emotionally attached to that premium you collected when you put the trade on. But a pro knows when the game has changed. Sometimes you absolutely have to be willing to give a little of that profit back in order to buy yourself some structural safety.
So what's the logic? Well, think of it this way. You are literally buying an insurance policy. When you roll your short call up to a higher strike price, it's going to cost you. It'll be a net debit. But what you're really doing is giving back a little premium to push your break-even point way higher. You're buying yourself critical breathing room and neutralizing that immediate directional risk.
And here's what that looks like in the real world. You start with this really dangerous position, a short call at 1280. We're going to roll that all the way up to a new strike at 1500. Yeah, it costs money, it's a debit, but the benefit you get in return? Peace of mind, and a position that's now structurally sound and way above those critical technical zones.
But I know that debit stings, doesn't it? Nobody likes paying to adjust a trade. So how do we help pay for that insurance policy? Well, that's where the second part of our strategy comes in. This is the subsidizing move, where we harvest some safe premium from the other side of our trade.
So now we look to the safe side of the trade, our short put. I mean, with the stock trading way up over 860, our short put down at 350 is so far out of the money, it's collecting dust. So we can roll that put up from 350 to 400. Because this new strike is closer to the money, it has more premium. This adjustment gives us a net credit, and we can use that cash to help pay for the call roll.
And when you put it all together, you can really see the elegance of this strategy. Step 1.
You harvest a credit by rolling up your safe put. Step 2. You use that credit to help subsidize the cost of your defensive move. Step 3. You buy that safety, rolling the risky call way up for a net debit. And the result? You've brilliantly used the safe part of your trade to finance the repair on the dangerous part. The whole position is now shifted higher, respecting the stock's powerful new trend.
And that leaves us with this final thought. A lot of traders would look at paying that debit on the call roll, and they'd call it taking a loss. But is it really a loss, or is it simply the cost of good risk management? Staying alive in this business isn't about protecting every single penny of profit on every trade. It's about making the smart, disciplined moves that ensure you get to stay in the game and trade another day.